Futures trading is a type of financial market that involves buying or selling contracts for the delivery of a specific asset, commodity, or security at a predetermined price and date in the future. Futures traders buy and sell contracts on the expectation that the price of the underlying asset will increase or decrease, and they aim to make a profit from these price movements. The underlying assets traded in the futures market can include commodities such as crude oil, precious metals, agricultural products, or financial instruments such as currencies, bonds, or stock indexes. Futures contracts are standardized and traded on organized exchanges, and the prices of these contracts are determined by supply and demand dynamics in the market. Futures trading is considered a high-risk investment and is typically used by more experienced traders who have a good understanding of the market, risk management techniques, and the ability to monitor their trades 24 hours a day. Additionally, futures traders need to have sufficient capital to cover margin requirements, as the margin is a deposit that provides collateral for the contract and can change as the value of the contract changes.